Our next presenter is David Garofalo, President and CEO of Gold Royalty, a precious metal-focused royalty and streaming company offering creative financing solutions to the metals and mining industry. Dave.
Thanks.
Dave, great to see you.
Thank you. Good afternoon, everybody. I'm delighted to be here. I'm glad you could join me this afternoon. We're entering into a very auspicious year in 2024 for Gold Royalty Corp. We were only founded a little over 3 years ago. We IPO'd in March of 2021, raised $90 million, started to consolidate some of our peers over the course of 21, and then been steadily growing through various means. We have various platforms for growth. In fact, we did M&A when we had a strong currency in 2021. We've done some project financings. We've done some third-party royalty acquisition, and we have an organic royalty generator model that's added about 60 royalties to what's now a royalty portfolio of 240 strong. And that's remarkable given that we started with a very modest, non-cash flowing royalty portfolio of only 18 royalties upon our IPO. So steadily been building out the business, and now we're in a position this year to actually generate positive free cash flow, positive earnings for the first time in our history. And I would say that that's a remarkable achievement in any business for a startup to go from really a standing start to free cash flow and positive earnings generation in the course of 36 months, and that's where we are today. And it's not from just a collection of early stage royalty opportunities. Yes, we have many of those in the portfolio. We cover the gamut in the life cycle of a mine from early stage exploration right through to production. But we have royalties on some of the largest gold operations in North America. We have royalties on 3 of the 5 biggest producing gold mines in North America, in fact. And we've now recently acquired a copper stream on the Varus large-scale silver copper mine in Bosnia, which is an 18-year plus reserve life. So we have generational foundational assets within the portfolio that provide us an underpinning of growth and cash flow for decades to come, in addition to the significant optionality we have in some of the early stage royalty opportunities. And I would say the reason we've been able to grow so rapidly is because we've leveraged a group of people within our board and management that have collectively over 400 years of experience in the industry. And not just as financial engineers. Many of us have been builders and operators over the course of our career. I spent 33 years building and operating mines, and that's a recurring theme within our C-suite, within our management group, and within our board, which gives us 2 distinct advantages. One is it gives us a clear-eyed view of the underlying risk of what we're investing in, so we can assure that we're going to get an adequate rate of return, but also gives us access. And the reason we've been able to grow so quickly is because virtually everything we've bought has been in a bilateral negotiation rather than a competitive process, getting in front of opportunities before our competitors are even aware of them, and being able to accumulate quality assets in quality jurisdictions in a very rapid fashion and generating strong returns in doing so. And this is just a graphical representation of what we've been able to do in 3 short years. Again, starting with 18 non-cash royalties, through our M&A activities, through project financing, through third-party royalty acquisition, also through royalty generation, which is really through our sweat equity. We've added over 230 plus royalties into the portfolio to supplement the 18 that we started with back in early 2021. In the course of doing that, we've gone from a 0 start in terms of the net asset value of our business to over $500 million on a consensus basis in the NAV of our underlying business. And we're projecting generating over $220 million of return in that portfolio through the end of the decade. And we're just getting started because many of these assets have decades of reserves ahead of them. So in terms of getting cash returns on the capital we put to work, it's happening today and it's happening quickly. And we're generating strong returns. It really puts us in a position to start to return capital to shareholders in relatively short order. You know, any presentation on the royalty business really should start with the fundamentals of the underlying commodity. Whether it's gold, which is over 90% of our business, or copper, which has now grown to about 10% with the recent Varus acquisition, the fundamentals are extremely sound. And if you look at gold over a 50-year horizon, it's really been a one-way trade. Yes, it's a volatile commodity, as all commodities are, but when you look at what gold has done since the gold standard was abandoned by the U.S. government in the early 1970s, it's gone from $35 to $2,400 an ounce today, whereas the purchasing power of the U.S. dollar, and for that matter, any of the major fiat currencies globally, has gone down 96%. The temptation to expand money supply is really limited just by the printing press, whereas gold is quite finite in quantity, and which is why it has been a reserve currency for 4,000 years, and why its purchasing power has not budged in those 4,000 years. Whereas the value of fiat currencies continues to be debased. What we haven't seen is a response in the performance of the gold equities. We think that's inevitable, and I think it's likely to be led by the royalty companies that provide optimum top-line exposure, optimum exposure to the exploration upside of our underlying properties that we have royalties on, while protecting our investors from cost inflation, which unfortunately is quite firmly entrenched in the general economy. Gold is an agnostic and accurate barometer of what's happening to real inflation. The CPI numbers are absolutely economic fiction. We're not experiencing 3 to 4% inflation. What gold is telling us is we're experiencing at least 15 to 20% inflation. And I think we all see that in our everyday lives. We see that in our everyday businesses in terms of the cost of inputs and capital costs and whatnot. And it's telling that after 33 years of building and operating mines, I'm running a royalty company. I believe in gold as an asset class, but I don't believe in the capacity of the operating part of our industry to deliver outsized returns in an upwardly dynamic cost environment. And it's a similar dynamic in the copper business. We see a supply deficit rapidly emerging as we see burgeoning demand due to the electrification efforts of our various governments globally. What we haven't seen is a supply-side response because of the lack of investment in exploration and mine development for more than a decade, and we've seen a deterioration of reserves, not just in the gold industry, but in the copper industry as well. There's simply nothing being built in the copper industry right now. That's why BHP is running after Anglo. They're buying, they're not building, and that is a zero-sum game for the industry. That's not adding value, it's just trading assets. And what that tells you is the incentive price for gold and copper is going to be far above what we're experiencing right now to incentivize the exploration and the mine development that this industry so vitally needs. This is just an overview of our pipeline. As I said, in a very short period of time, we've introduced dramatic increased optionality in our portfolio, again, right across the life cycle of mining, from early stage exploration to late stage development and cash flowing assets. We have 8 that are cash flowing currently, 14 in various stages of construction that's driving significant revenue growth right through the end of the decade. Again, generating a $2,000 gold, $220 million of revenue on a consensus basis through the end of the decade, really recovering almost half of what we put to work in a very short period of time since our inception 3 years ago, with a very diversified portfolio of operating companies that we do business with. Most recent acquisition is Varus, a copper stream on the large-scale silver mine that Adriatic has just finished construction of in Bosnia. Started production in February, just produced its first saleable concentrate. And what we like about this is the fact that it's polymetallic, long life, and polymetallic deposits tend to have longer lives. They tend to have lower cost structures because of the byproduct credits. And so they're an economically robust type of environment to invest in, and that certainly creates with Varus, which not only has a long mine life at 18 years, but has significant exploration upside and expansion potential. And the operating company just raised $50 million to that end to invest in the expansion of that underlying operation. So shortly after achieving production, they're already looking at the next stage of expansion. The great thing about the royalty model, again, is our royalties are completely bought and paid for. Those operators have to go out there and raise the capital to do that. We just participate in the upside. We've already invested our capital. We get to harvest the returns not only on the base case of what we invested in, but any expansions they undertake as a result of their capital raising efforts or any exploration they undertake, again, on their ticket. And to that end, our operating partners each year invest over $200 million in exploration on their underlying assets. We contribute absolutely nothing to those exploration budgets, but we get all of the exploration upside translated into our royalty interests. And that means that our royalty portfolio now has 120 million ounces of gold equivalent underlying our royalty interests. And that's bigger than any of the seniors in terms of the reserves and resources in the mining business right now. What this translates into in terms of short-term revenue growth, we're seeing almost tripling in our revenue from last year, incorporating Varus into the royalty portfolio. That brought in another 27%, a further 27% increase in royalty and other revenue as a result of that acquisition. But our royalty revenue was poised to double even before that acquisition. And that's what's tipping us into free cash flow territory and positive earnings territory for the first time in our very short history since our IPO in March of 2021. What this translates in through the end of the decade, again, these are all consensus numbers, is 60% compounded annual growth in our revenue right through the end of the decade. And it is from a fairly diversified portfolio of assets, but most of that revenue growth is coming from some of the biggest operating mines in North America and in the world. We have a royalty on Canadian Malartic, one of the top 3 gold producers in North America, owned by Agnico Eagle, my old company. We have a royalty on Côté, which will be the 2nd or 3rd biggest producing gold mine. It just achieved production and hopes to be in commercial production in the 3rd quarter of this year. And we have a royalty on the highest grade portion of the open pit at Côté. And we also have a royalty on the underground extension of Goldstrike, the biggest producing gold mine in North America. So we have a qualitative aspect to our business, not just a quantitative one. Yes, we have many royalties. We have 240 royalties. We have many early stage royalties, but we have generational assets, cornerstone assets that really will keep Gold Royalty thriving as a going concern and returning capital to shareholders for many, many decades to come. And this is at $2,000 an ounce gold, I should add, and at $4 copper with consensus price estimates. So we have significant leverage also to the upside in the gold price, well beyond what you're seeing here in terms of the consensus estimates and revenue through the end of the decade. And again, driven by some of the best operations in North America, but with a reasonable amount of diversification geographically, but I would say with a heavy concentration in Nevada, Quebec, and Ontario, which perennially are rated among the top 5 jurisdictions globally for mineral potential, low political risk, and low regulatory risk. And that does matter. Given what's happened to Franco-Nevada and Panama on their stream, it's very important to be in jurisdictions that respect the sanctity of our contracts, because at the end of the day, royalty and streaming companies are frankly just a collection of paper. We own contracts. And if we're not in areas that have jurisprudence and protection around the sanctity of those contracts, we frankly shouldn't be there. And that's why we've been very careful in terms of curating the jurisdictions that we are willing to do business in, but with very high quality projects. The re-rate potential we think is immense. When you look at the landscape of royalty companies, and there's been a proliferation of them, and there's been some consolidation of late. 9 royalty companies have disappeared since our IPO back in March of 2021. We absorbed 3 of them. There's still re-rate potential that's immense relative to where the seniors are trading in the space. You see the seniors are typically trading at 2 to 2.5 times price to net asset value, and many of the smaller players that are sub $3 billion market cap are trading at significant discounts to the seniors. And the opportunity here is to create scale quickly. We're going to be able to do that through effectively harvesting from a prolific and very diversified portfolio that we've already bought and paid for. We think there's going to be further consolidation to achieve scale quickly. And we think the re-rate potential is immense, not only on our own, but through the consolidation that we think will inevitably happen as these companies all strive to achieve scale quickly to start to match the scale that the seniors are experiencing and being paid for. But I think the difference between the smaller players and the seniors is we can deliver growth. You know, when you're a $30 billion market cap company, there isn't any individual royalty streaming deal you can do that moves the needle, that delivers significant growth. With these smaller companies, we think we can achieve scale, which makes us institutionally relevant, but we also think we can deliver significant growth off a relatively small base, as we've demonstrated in our revenue growth, which is peer leading in the industry, and we talked about a few minutes ago. And if you don't believe me, look at the strategic shareholders we've been able to accumulate that understand the business intimately. We were spun out of gold mining several years ago, and they retain all of the stock that they've ever owned. They own about 13% of the company. Nevada Gold Mines, Barrick, and Newmont are about 5 or 6% of the company after our recent Varus acquisition. Queen's Road Capital out of Hong Kong, Taurus out of Australia, Orion out of New York have all vended assets into the company or helped us accumulate assets and provide us creative sources of capital in order to continue to grow our business, and our steadfast shareholders and also potential sources of capital going forward as we're looking to grow our business and again build strength upon strength as we have over the last several years. With that, thank you very much for your attention today.